UNH stock. Okay, so we got to differentiate this one between trading and investing. Okay, so as a trade, if somebody's trying to play the stock for the next, few weeks, the next few days, whatever, the stock could do whatever. Like, who knows how the stock's going to do? Do I like UNH over like buying UNH now and holding it for the next several years? The answer is no. Here's why. Okay, so if you didn't know, very recently here, United Health Group is under criminal investigation. Not civil investigation. We're talking criminal investigation. That's a big difference between civil investigation and criminal investigation, okay? Usually things don't go to criminal investigation unless a government entity already has a lot of proof of something. And keep in mind, right now, these government entities, because of what's happening with Doge, they don't have big budgets to really so if they're going after any company right now, they got to kind of feel like it's a slam dunk. So we'll see what comes out in regards to this, but United Health Group is under criminal investigation for possible Medicare fraud. It's very interesting that they'd be under criminal investigation and then the CEO would just dip on the company, right? So think about this for a moment. The last CEO was shot. Countless people were happy. Happy the man was shot, which tells you how much so many people, so many of the company's customers hate the company. I don't think that's ridiculous. The fact that a CEO could be shot and people would, be secretly happy about that, and a lot of them weren't secret. Like if you read social media posts and things like that after, a lot of people were, let's just call it, they were happy that whole situation happened. And that's crazy, man. That shows you how much people hate this company. So it's a hated company. The government, I would assume, has some sort of substantial proof of what they're claiming here, right? And the fact that the new CEO that took over for the one that got shot, right? The new CEO is like, dude, this is such a mess. I'm dipping on this. That's not good. So when people look at United Health, they look at it and they say, man, look at how consistent this company's been. Like, it doesn't take a rocket scientist to look at that chart and be like, oh, man, that's impressive, right? And they think about all the free cash flow the company generates and all the profits and things like that. But what I could see potentially happen is I could see UNH potentially getting hit with a double whammy here. One is they're going to have to deal with these massive investigations that will probably end up lasting years. It probably won't just be wrapped up in a few weeks or a month or something like that. You're looking at probably a year or multi-year investigation, right? Massive legal fees, ridiculous legal fees United Health is going to have to fork out here. My assumption is they're going to get hit with huge fines. And third, I believe the government will force their business model to operate very differently, which in my opinion will make the company far less profitable than it's been in the past. That's my assumption on how this game ends up playing out. So for me as an investor to look at this and say, do I want to get in this for the next several years? The answer is absolutely not. And you know the way I love beating down dog stocks. I've been buying Estee Lauder recently and Nike recently. There's certain companies that I see and I'm like, that's been a company that has been tremendous the last 20, 30 years. I think they're going to be tremendous the next 20, 30 years, and it's a great time to buy the dip on this stock. It's down 50%, 70%. United Health is so messy, and it's going to be messy for years, in my opinion. It's not going to be messy for a week, a month. No. This is going to be a mess for years. And so what could end up happening is you could get a stock situation like Boeing, for instance. If you look at Boeing's been a mess for 7 years now, 8 years. Let's take a peek at Boeing stock, for instance, right? Because I think that's a good one to kind of give an example. And every time you think the mess is cleaned up in regards to Boeing, it never cleans itself up, okay? It never cleans itself up. If you look at Boeing stock here, this stock is back to levels it was 10 years ago or so? The stock today is lower than it was back in 2017. You heard me right. Boeing stock, which Boeing was a tremendous company for the longest time, highly respected, that stock is lower today than it was in 2017. It's 2025. And so with United Health in regards to the situation, as a trade, who knows, man? Maybe it could be a moneymaker for the next few trading days in the next few weeks. But as an investment, I want no part of a company like that. No. Way too much of a mess. And you know it's a mess when even I say it's too much of a mess, right? Because I'm not afraid to get in a messy stock and a messy company. So when I say it's too messy, it's too messy, okay? Elf on a shelf next up here. So this stock has climbed significantly from those April lows it hit. It's already up 64%, right? Which is wild. I mean, that's basically just over a month's time up 64%. I mean, that's usually what you would want to make in 5 years, index fund or something like that, and it just gave you that in a little over a month. But in regards to ELF here, what really matters for ELF is actually not the numbers they're about to report. It's what the guidance is. What does the company have to say about full year numbers? So that's the second part. And the third part is the conference call. And what does the company have to say about tariffs? If the guidance is good for next quarter, if the overall feeling for numbers for this year is good, right? And additionally, they can just kind of get everybody off this tariff craziness and understand like, hey, we're going to be fine. Like even with this tariff rate, here's what we're doing to, make sure our margins aren't going to fall substantially or anything like that. As long as investors can walk away with that, I think the stock could go to $100. But those three things have to happen, right? Now, if any of those are a problem, we got a problem with the stock, right? And it could go back down. Do I see it going back down to where it was, back in April? No. But could it go down 10 or 15%? Let's say if the guidance is weak or the full year numbers are weak or the conference call doesn't explain enough. Yeah, I mean, sure, something like that can happen, right? But the moral of the story is here, if you look at kind of what analysts are expecting, they're expecting this company to just have like almost no growth, little to no growth for like the next year, right? And then eventually get back. I mean, here's where the upside can come. If, let's say, ELF's thinking they're going to grow much more substantially than what analysts have, big upside to the stock. And then once again, if they have that along with explaining how they're going to mitigate this tariff risk and that margins will be able to hold pretty strong, like there you could either go down slightly but is it going to be like no fall off the cliff situation? Because everybody loves ELF's gross margins. They're ridiculous, right? 70% plus number. We'll be fine. And so that's kind of what's going on in regards to ELF situation. Now, Celsius here, this stock has climbed 52% just in the past 3 months, which is very impressive considering the S&P 500 is down 2.7% in the past 3 months, and the Qs are down about 3% in the past 3 months, right? So in regards to Celsius, the exciting thing for Celsius now is they're about to go through another massive growth cycle. And that's what people actually want to see from Celsius right now. The margins and the EPS are going to matter much more, I think, in 26, 27, 28 as you go further out. But in the short term here, people really want to see that growth reaccelerate again. So they want to see Celsius grow and they want to see the Lonnie business numbers coming through. And so I think you could get a lot of excitement around Celsius for, a while now at this point in time, now that they're about to get back to major revenue growth again. The margins could be messy in the short term. The earnings per share could be messy in the short term because of the whole acquisition and doing that deal and fitting them in the system and everything like that, right? And getting the distribution where they want it and the points distribution. But people are kind of going to look past the margin, the EPS short term. We want to see major revenue growth acceleration again. And so if we see that, I think that's going to bring a lot more excitement in the stock. And next thing you know, we'll be back over 50 in no time, right?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with.
What happened with Meta? Is it a big deal? Alrighty. So Meta, obviously it's been a tremendous gainer for us. Today was an L, right? But it's been a pretty good stock. We're up $844,000 on the stock, and the public account up 458%. So news came out a little while ago that Meta's delaying its rollout of its flagship Behemoth AI model. Originally scheduled for release in June, has been pushed back to the fall or later, right? Nothing burger. Absolute nothing burger. At the end of the day, when that model does come out, look forward to it. I think it's going to be great. The Llama models have been very successful so far in these very early days, and I'm sure this Behemoth model is going to be massive as well. And so, hey, more hype and excitement can build around that model for now. I'm sure Zuckerberg looks at it and he'd rather things be exactly where he wants them. So, it can be phenomenal, and hey, builds up more hype and excitement for when it does come out. So at the end of the day, this means absolutely nothing. Understand everything that Meta's doing AI related right now. Understand that's just setting the company up for the next 10, 20 years. You understand everything that's like with the numbers today is all Facebook, Instagram, and WhatsApp. And that's what's really going to dictate the numbers for the next several years as well. All this AI model stuff, Llama models, Behemoth, all this stuff, that's setting up Meta for the next several decades, okay? And so they're just making, Zuckerberg and the team is making sure everything's exactly the way they want it, and it's going to be, very successful. Company's well on their way, so I have 0% concerned. It's not like I was looking at Meta. And you know what it makes you feel really comfortable about Meta? Is the P ratios. Forward P on the stock is, 20s. When I'm dealing with a stock that has double-digit top-line growth, double-digit bottom-line growth in trades at a forward P in the 20s, easy peasy, lemon squeezy. So Dick's Sporting Goods getting smashed here today. So this stock year to date is down about 21%, but keep in mind a lot of that is because of today, down over 14%, right? On a one-year basis, it's down, we can call it about 11%. On a 5-year basis, it's actually about a B stock. It's up 544%. So clearly over the past 5 years, the company's done very well. So when it comes to Dick's Sporting Goods, low valuation name. And guess what? They just bought out another low valuation name. Like Foot Locker. Foot Locker has been going through a bunch of transition in the past a year and a half in regards to transition their business model and getting rid of some stores and things like that. But traditionally, Foot Locker was always extremely profitable. And I'm sure they'll get back to extreme profitability over the next couple of years here. And they usually always trade at very low valuation multiples. Like Foot Locker would usually trade between like an 8 and a 14 forward P. Very common. And so Dick's Sporting Goods trading at 12 doesn't surprise me. So at the end of the day, I think it makes sense for Dick's to make a move like this, do a deal like that. He's going to give him a way bigger presence. You got to understand, Foot Locker also owns brands like Champs and a few other brands as well. And so that's just going to give them even a bigger footprint, no pun intended, in regards to footwear and shoes, and even more pricing power with Nike, Adidas, Hoka, On, all those type of brands, right? And so I think the deal actually makes sense for Dick's. They can probably cut some of the, my thought is they'll have this transition period for the next kind of year or two where they integrate it in, and then they'll probably fire a bunch of the big money folks at Foot Locker, and then they'll just use their Dick's team to kind of oversee that. And so, probably makes sense. But am I going to go out there and run out and buy Dick's Sporting Goods today? Probably not. These retail businesses are just very, very difficult. Like very, very difficult. And the stocks always trade at bad multiples. And it's hard to grow these companies much more. And Dick's Sporting Goods is a perfect example. Like, Dick's Sporting Goods would not be buying out Foot Locker unless they were worried about growing their organic business. And that's exactly what's going on here, right? Dick's Sporting Goods is having trouble figuring out more locations to build Dick's Sporting Goods. And so they say, okay, how can we grow the business? Buy out somebody like a Foot Locker, and boom, then you just increase your likely EPS massively over the next 5 years. And so makes sense for them, but yeah, I'm not super interested in buying that one, right? Cava Group. So this stock, let me be very clear about this one. Am I interested in buying this stock? The answer is I would be interested in buying Cava if it traded at somewhat of a decent valuation. The issue, and it's a big issue in regards to Cava, is this one trades rich. We're using 1000xstocks.com to look at this. Look at the forward P of Cava. 180? Look at the 2-year forward P of Cava. 147? Dude, we're talking these are like Palantir. These are like Palantir ridiculous valuation. Like Palantir gets all the hate in the world because it's so overvalued. Look at the forward P on Palantir and all those sorts of things. And let's go to the compare feature, and we'll compare Palantir next to Cava, okay? And you can take a peek here, because Palantir is obviously one of the most hated stocks in the stock market when it comes to the valuation multiples, right? Palantir trades at a 2-year forward P of, let's call it high 100 range. Cava trades at around 150. Listen, if you had to compare Palantir's business model versus Cava, Palantir's got it's a night and day better business model than somebody like a Cava. Like Cava business model sucks compared to Palantir. Cava's got to actually open up massive amounts of new locations, buy tons and tons of restaurant equipment, right? Hire all new employees, have those employees well trained so the product can be consistent, whether you go to a Cava in Minneapolis, Minnesota, or whether you go to a Cava in Scottsdale, Arizona. It's got to all taste the same to you, right? No different than Chipotle or Chick-fil-A or anything like that. And that's a tough process to do. And it's extremely costly. It takes you years to get the profits out when you actually open up a new location, right? It's a pain. It's a tough business model, man. It's a very tough business model. And it's fine to buy those sorts of business models if you get them at low multiples, but when we're talking about these sorts of forward P metrics, it's off the charts ridiculous, right? And I give you a much better stock, in my opinion. It's not even close. And it's another C. It's Cake. And Cake has a way better risk-reward profile. Look at that. Forward P on Cake is 13. And here's the thing we know about Cake. They got two banger concepts that are going to be expanding all over the United States of America over the next 10 years. So you're going to see Cava expand all over the United States over the next 10 years. Cake has 2 concepts that are going to be expanding all over the United States of America over the next 10 years. One is North Italia, and the second is Flower Child. And, Flower Child has even more expansion opportunity than actually North Italia. North Italia, a little, let's call it catering a little bit more to the top 40% of income earners, whereas Flower Child is going to be more of for the masses, right? Because much of Flower Child's products are $15 or under. So Flower Child is actually much more of a competitor to somebody like a Cava. And so I look at a Cake and I look at a Cava, and Cake's just got way more upside potential over the next several years and way less downside, right? Because of the multiple. And you got to understand that's what matters so much in the stock market. Like, people get caught up in these stocks with these insanely rich multiples. You're setting yourself up for major, major risk. If Cava was trading at a 25 forward P or a 35 forward P, I'd feel very differently about it. I'd say, okay, this concept's going to be expanding all over. It's at a realistic multiple. Yeah, it's a tough business model, but at the end of the day, it's worth it. That's where it comes into trouble. So these sorts of stocks that trade at very high multiples, they could be more trading stocks. These Cava type companies, right? They could be treated as more like for traders, and they can go through some crazy up cycles, and then next thing you know, their stock crashes 50-70% like that. Cake's just more steady growth, and you look at Cake's stock price. I'll show you some sweet Cake over the past year. So Cake stock over the past year is up 34%, right? Cake has severely outperformed the NASDAQ and the S&P 500, and it's not even close. Cake is up 34% in the past year. QQQ is up 14%. S&P 500 is up 11%, right? That's the magic when you got a company that has lower risk than the market in general, but has much greater upside potential, right? And that's Cake. Now, next up here, listen, I gotta teach everybody something very important here, okay? Listen. I mentioned Revolve stock on X here today, right? And I said, I have a stock that has a great balance sheet, income statement, management team. No one ever talks about the stock. It's like it doesn't even exist. It's Revolve, right? And somebody made a big mistake, and they said, oh, the stock price is down, whatever amount, so far year to date. So, no thanks, not even worth looking into. Listen, man, that's not how you do stocks. When you hear about a new stock, what you do is you then go look at what the company's business is. Like, is it a B2B business, a business selling to businesses? Is it a B2C business where they're selling to consumers? What type of products and services do they have? If you like the products and services the company has, you feel like it's pretty compelling. From there, you start to look into, okay, who does this company compete against? What's the risk to the business model? how can this company grow these products and services and continue to pour in a lot more revenue and profits in future years than they have today, right? You can start looking at investor presentations, listen to conference calls, reading annual reports if things keep checking. Then you can look at income statements, balance sheets, cash flows from there, right? Then from there, you can start looking at valuation. You start looking at the P metrics like we were just doing on stocks, looking at the forward P, thinking about future growth rates. Does this make sense, right? You can use valuation models like we have on 1000xstocks.com, right? Our projections tab, where you then start to run your projections on a stock and you start plugging and playing numbers and say, okay, does this make sense? Is this a great buy here? From intermediate, then you can go to advanced projections and start entering in all your numbers and run sophisticated models, right? And you can even save your files on 1000x. That's how you play the game, right? And then you figure out, okay, do I want to buy the stock or not? To, pull up a 1 year chart of a stock or a year to date and say, oh, the stock's down this year, so it's a bad stock. Or the stock's up this year, so it's a good stock. No. Look at the fundamentals. The fundamentals are what's going to be what drives that stock over the next several years. Fundamentals and the valuation. If the valuation is fair or compelling and you buy into a stock and the fundamentals get better and better over many years, the stock goes up. And the more it does so, the better the fundamentals are and the more attractive the valuation was when you got in it, likely the more money you're going to make. Look at an example like a Palantir, right? Up like 1,600% on Palantir now at this point in time in the public count. Why is that? When I got in Palantir, the valuation was extremely compelling. It was like $7 stock. And what has happened to the fundamentals of the business? They've increased exponentially over the past 2 or 3 years, like night and day different business model, right? And you make some insane gains. That's what happens. I've never seen it where somebody gets I've seen it before where a company's fundamentals get better and better, but people paid a ridiculous valuation for it, so they didn't really make any money in the stock over the few years. I've seen that plenty of times, but I've never seen it where a company was at a very compelling valuation, somebody buys into it, the fundamentals get better and better year after year after year, and they don't make money. Never seen it. Never seen it, because it doesn't exist. Because at the end of the day, if a company's at a very fair valuation and the fundamentals get massively better for the company, the stock will perform tremendous, right? Look at Dick's Sporting Goods. That was a perfect example. Look at how well that stock has done over the past 5 years, right? Fundamentals got better with the company. If people bought in 5 years ago, they got it at a very discounted rate. Because what was going on 5 years ago? I'll tell you what was going on. The worldwide economy was shut down. Kids weren't playing sports. There was no sports going on. So somebody like Dick's Sporting Goods, people had fears where, is that company going to go bankrupt? Like, what's going on there? No one's playing sports. Numbers are going to be horrible. The valuation got to very compelling levels, and the fundamentals of the business have gotten massively better over the past 5 years, and the stock price is up 500% or whatever that was, right? It's a simple game, but you can't just look at a stock chart and say it's up, so it's good. It's down, so it's bad. Like, no. Especially on a short-term basis, that's a foolish game, right? Now, Warren Buffett bought into a few stocks here: Constellation, Pool, Domino's, and Heiko. Pool and Domino's are really the only two that really interest me here out of this bunch of stocks. So we're going to take a peek at Pool, and which kind of has a little bit of a monopoly. And then, what is it, DMZ, Domino's? What is Domino's ticker symbol? Domino's. No, that's not the right Domino's. Is it DPZ? DPZ, maybe? Let's see. DPZ. Yeah, there's Domino's. Okay, so let's pull up Domino's, and let's pull up Pool. So Domino's 27 forward P, Pool's at a 27 forward P, 2-year forward P around 24 for Pool. I can understand why Buffett likes Pool, because they kind of have a little bit of monopoly on the industry and in the specific product segments they compete in. It seems like a Buffett-type business, and it trades at a fair forward P, right? Given the position this company has in the marketplace. So I get it. Like, I see why Buffett likes a Pool. Do I like Pool? I think it's okay. It's not like a stock that I'm like, oh my gosh, this is so exciting, I'm going to go out and buy this. But it's a very Warren Buffett-like stock. Very Warren Buffett-like. And I wouldn't be surprised if it performs just fine over the next few years. As a matter of fact, let's take a look at Pool stock over time. Pool stock. Let's take a peek here on a 5-year basis. Stock's up 40%. So, yeah, seems like a Warren Buffett-type stock, right? But, and then in terms of Domino's 27 forward P, 2-year forward P 25. I don't hate Domino's, but I don't like it either. Probably not a stock I'd be interested in buying. Like, you look at Domino's, They have Domino's just about everywhere you'd possibly want Domino's, just to be honest. It's not like this is some major expansion opportunity. It's like, we're going to be able to build so many Domino's over the next 10 years now. Additionally, we know that space is insanely competitive. You know, you got a Domino's, it seems like everywhere you could possibly want a Domino's, but you know what else you have everywhere? Papa John's, Pizza Hut, right? And then you have these like regional pizza places that they'll have like 100 locations or a few hundred locations. And then you got all the mom and pop pizza places, right? And so that whole category is just extremely competitive. And so Domino's is like, okay, but it's just not the most attractive stock in my opinion. But it's okay. Like, you know, it's once again, it's a Warren Buffett type stock. You know, you kind of look at that one similar to like how you would look at a, I don't know, buying who? McDonald's? Something like that, right?